Nowadays, literally anyone can and has access to invest, but majority of people were not taught how important taxes are and how significantly they can affect your net investment returns. In today's video, we're covering taxes on stocks explained for beginners and simplified as to how taxes work in general, no matter what country you're in. It is important to understand what the tax rules are so that you can ask the right questions to professionals so that you're able to make decisions that can legally minimize the tax that you'll be required to pay in any given year. So I'm going to give you an overview of what you should do with the gains that you make in the stock market, the money that you may lose on other individual stocks in the stock market, and your dividend and interest income related to stocks, and how to make decisions to reduce your tax in the stock market. Okay, so let's dive straight into the basics. The first aspect to understand is that there is a tax year, and you are taxed based on what occurred during that specific time frame. In some countries, it may be the same as the calendar year, but where I'm from, the tax year runs from the 1st of March to the end of February. And a quick Google search will easily give you this information based on what country you're in. Next, we're going to cover the most common situations in the stock market. As with a salary or any other income that you earned, you're only taxed on the money that you make from the stock market. But in this case, if you lose money and you actually realize those losses, which we'll get to shortly, then you'll be able to offset these tax losses against any gains made within a tax year. So let's walk through an example to clarify. Let's say that you bought Microsoft stock for 1,000 of whatever currency you're working with, doesn't matter, and 2 months later you sold it for 1,200. So congratulations, you made a gain of 200 in the stock market. So the next concept to take note of when it comes to calculating taxes is that you only ever pay taxes on the gain made. So not on the full sales price of 1,200, but only on the gain of 200. And the amount that you pay in taxes is going to depend on the tax bracket that you're in. And that depends on the amount of money that you make overall from all your income streams. Let's say, for example, that you're in the 15% tax bracket, because your annual income from all sources reflects the total amount that you earn during the tax period. This means that you'll owe the government tax collectors, the IRS, SARS, HMRC, 15% of 200, which is 30. So you actually made 170 in net profit. But if you're in the 40% tax bracket, then you will have to pay 80 in taxes and only make 120 profit. And so here the second concept to understand is how income tax is calculated. Because the common misconception is that the more money you make, the higher tax rate you'll pay on your full salary and all other income earned. But actually it works on a marginal tax system. So if your salary increases, for example, then only your additional salary may move into a higher tax bracket, not your entire salary. But here is what you must know to save yourself a lot in unnecessary taxes. If you hold a stock for a long period and intend to hold that stock for a long period of time, then you're subject to capital gains taxes, versus over the short-term side of the stock being classified as income and included in your personal income tax. Okay, so if you're following along and you don't have a background in finance or tax, then you are absolutely crushing it. But just a disclaimer, I am a qualified accountant, but I am not a financial advisor. There are a lot more specifics when it comes to tax and your situation, so please keep that in mind that this is merely an overview of tax fundamentals. With this information, you need to find out what is relevant to you and seek financial advice in the country you're in. And if you've been enjoying this video so far, please drop a like and subscribe to the Money Minded channel. Okay, so moving on, basically long-term capital gains will receive much better tax rates than your personal income tax bracket rates. And it doesn't matter which tax bracket you're in, the tax treatment will be better regardless of whether you earn a low income or a higher than average income. So let me explain. If you make a lot of money at your job and you are a C-suite executive, for example, and in a 40% tax bracket, then your long-term capital gains will be taxed at, let's say, 25%, for example. And this is because, and here's where it will differ from country to country, in some countries, there is a proportionally lower capital gains tax rate, which is based off the total income you earn. And in other countries, because of the standard annual exclusion and the remaining balance of gains made from investments being added to your personal tax bracket calculation, the tax rate paid on the capital gains portion is lower than the rest of your income that is taxed. If you are in the lowest tax bracket, then it is likely that your capital gains tax rate could equal 0%. Therefore, regardless of what tax bracket you're in, long-term capital gains will receive favorable tax treatment, so keep this in mind as it's going to save you a lot of money. especially if you're sitting on a stock that has done really, really well. And that leads me to another very important point that you must know. You are only liable for tax when you actually close that position, or in other words, when you actually realize those gains or losses. To explain this, let's say that you bought Microsoft in 2020 for $1,000. And by the end of the tax year, the stock had gone up from 1,000 to 1,450. But you didn't sell it, you kept holding on to it, because your investment strategy is to invest in quality businesses for the long term. So it stays as unrealized gains, and you didn't sell, which means you didn't trigger any tax liability. And let's say it is now the 2021 tax year end, and your Microsoft shares are sitting at 1,600 price. But you continued to just hold the stock and didn't sell it. So again, no tax was triggered. So there's nothing to report when filing your taxes. And no tax is liable relating to this specific investment because you never closed your position. Towards the end of 2022, you finally decide to sell the stock as the price reached 1,850. So your realized gain is 850. The price you closed your position at, less the cost you bought it at. Therefore, you will only be taxed on the 850 gain that you made. However, because you held the stock for long and intended to hold the stock for a long-term investment, it is considered capital in nature, and your country's relevant capital gains tax rate will apply, which is much better tax rates than if this gain on the sale of the Microsoft shares was considered to be part of your income and included with all your other income and taxed at the applicable personal income tax bracket rate. Now let's talk about what will happen if you lose money in the stock market for buying Tesla, for example, and how to use this loss to decrease your tax liability. So when you incur a tax loss in the stock market, then you're able to use this tax loss that you incurred as a tax deduction and offset it against any tax gains made within the stock market in the same tax period. This allows you to pay less taxes. But let's be clear, losing money in the stock market is never the best idea to try to do. You're always better off if you make a gain in the stock market and pay your taxes than just incurring a loss. But if an investment is in the negatives from your starting price, then at least you can consider selling it, realizing those losses, and offsetting it against any gains that you are planning to sell within that tax year. So let's run through 3 quick examples to explain this better. You have some extra money, you decide to invest in the stock market, and let's say you plan to buy 2,000 worth of Palantir stock. But your investment then declines to a value of 1,200 in the same year, and you decide to hold on to it to see if it recovers. You know no tax has been triggered because you didn't realize your loss. Therefore, tax will only be triggered in the tax year that you sell the stock for a gain. Example number 2 is the same. You buy 2,000 worth of Palantir stock, it declines to 1,200, but you just can't take it anymore. The stock is stressing you out too much, so you sell it for a loss of 800. But hey, on the bright side, you get a tax deduction to use against other gains made in the market. And so you offset this loss against your other gains and effectively reduce your tax liability. In example 3, let's say that during this tax year you made a loss but realized no gains. So there are no gains which you can offset this loss to. This tax deduction can usually be carried over to the next tax year and utilized later when you realize gains. Also, there are limitations to the quantity of losses that you can use as a tax deduction within a tax year if they are too large. So you don't lose your losses, but you also can't ask for a tax refund for a loss in that year. Now let's look at taxes on interest and dividends that you may receive from any cash not invested within your brokerage account and dividends from any dividend yielding stocks. Often these numbers are automatically pulled onto tax forms, but you may also have to input the numbers yourself. And how tax works on this is that there are certain standard amounts that each person and sometimes companies, although the quantities per person and company will differ, which are exempt from tax. And any interest and dividends earned above these exemptions will be included in your personal income tax bracket with all your other income. Another way to minimize tax is to invest in tax advantageous products where all your interest, dividends, capital gains grow tax-free. This was a beginner's guide to taxes on investments in the stock market. I hope it was helpful and can guide you to direct future tax questions. Subscribe to the channel for more content like this. Have a great rest of your day and stay money minded.